Thanks for tuning into Talking Point. I'm your host Niraj Shah, and it's a special Talking Point. It's Diwali, and we have the Diwali lineup for you. A very special voice, Hiren Ved, Director and CEO at Alchemy Capital Management, with us in the studios. Hiren, so good having you. And to you and yours, at the outset, a very happy Diwali. May you have a blistering Diwali and a fabulous New Year.
Thank you, Niraj. Wish you and your family and all your viewers a very, very happy Diwali.
Yeah, I mean, a lot of our viewers, Hiren, would typically judge how good or bad the Diwali and the New Year is by how well the markets do or don't do. The last 1 month hasn't particularly been great for the bulls.
Yes.
But was this coming? And is this likely to last?
So I think, we've seen a little bit of a soft patch in the economy. Q2 earnings have not been that great. Last 2-3 years, we've seen scorching earnings growth, right? I mean, the broader markets have delivered like 35-40% earnings growth, not seen in the decade prior to COVID. So I think we're seeing a little bit of a combination of a high base effect continue and a little bit of a slowdown in economic activity post the elections, right? I mean, government spending is running 35% below budget, right? While government revenues are almost running at or maybe slightly below budget, right? And I think yesterday the fiscal deficit number came. When in the last so many years have we just spent 29% of the fiscal deficit in the first 6 months of the year? So what it tells you is that government spending is yet to happen. Hopefully, post-November, the Maharashtra elections or whatever, you should see an acceleration. So the numbers are very interesting, right? I mean, we budgeted for 11,000 crores of spending. That's a run rate of 93,000 crores a month of central capex that the government has to do. We've been running at 58 to 60,000 crores, right? So either in the next 6 months we spend over 1 lakh crores a month to get to 11 lakh crores, or we'll end up spending less, in which case our fiscal deficit will be much lower, right? If the fiscal deficit is much lower, that should give us the impetus to cut rates faster, hopefully. But if we spend that money, hopefully growth also picks up over the next 6 months. So I'm quite hopeful. My sense is that this is a very temporary kind of slowdown. I do see growth picking up in the next 2 quarters. And I think the fourth quarter should be by far the best, which is usually also seasonally the best quarter.
So you see this happening independent of whether the government decides to spend large sums on capex or just reverts to mean as well?
Well, even if they end up spending in and around what they've budgeted, that should be good enough, because that's a lot of accelerated spending in a very short period of time. Now, whether they'll be able to do that or not, we don't know. But at least they will accelerate from where they are today, right? So I think that's very important.
Got it. Dude, in your sense, aside of being selective, but has private capex, is that showing signs or promise of coming up? Because, I mean, if it was a very strong and buoyant Q2 and capacity utilizations level were high, you would presume that a lot of sectors will see private capex. We're not quite seeing that, right? So is it waiting for elections, blah, blah, etc., US, etc., to go up? What's the reason?
No, Niraj, I think we are all mistaken, because, we have this thinking about that private capex is not picking up, right? If you go back to the previous cycle, a lot of the private capex was happening in the infrastructure sector, where on BOT projects, for example. So the EPC guys were also becoming asset owners. They don't want to do that anymore. Right. Name me one EPC company who wants to own a road asset, right? So I think that the capex, but if you look at renewables, everybody is putting up renewables capacity. So capex is happening. But I think in the traditional sectors as we thought it, like all thermal capacity is largely being set up by the PSUs, right? It's not the private sector that is doing it. In the previous cycle, every group worth its salt
Was putting up thermal
was
capacity.
putting up thermal power capacity,
Yeah,
whether
yeah.
it was Tata, Reliance, JSW, whoever, you
What
name
have
it, right? A few of them, JSW is still there. But everybody is focusing on
Renewable.
renewables, right? And in renewables, the capex is deflationary, right? So the per megawatt cost or, you know, everything is coming down as opposed to thermal, where costs were much higher. So if you look at where else is growth, EMS, for example, you talk to Dixon, you talk to Keynes, you talk to Sirma, you talk to all these, everybody is setting
Setting
up
up
capacity,
capacities.
right? So it's not that capex is not happening, but it's not as capital intensive as it was in the previous cycle. The nature of capex is changing.
So
right?
India needs an aggregate number which is high for employment, for the headline numbers to show up. Does that happen or does it not necessarily happen, and therefore don't look at the private capex as the barometer of where growth will come from? We have to look at something else.
Yeah, I mean, okay, let me give you another example, right? I mean, if you look at the last 3-4 years, the amount of money that the so-called new age companies have burned, it's capex for them, but it shows up as opex, right? So they don't put up plant machinery, etc., right? So it's all people costs, you know, travel costs, whatever, and then they subsidize for acquiring a customer.
Got it, got it.
You know, you give discounts, but that's OPEX, it's not CAPEX, right? Now, we've seen many new businesses in the new age businesses being set up. They all spent the VC money or the first few rounds of investors' money to acquire a customer base. Now they're cutting spending and trying to monetize all of that, right? So I think the nature of CAPEX has changed. You know, I mean, you will still need to do a lot of capex on, for example, metals. I mean, you know, there you know, it's the same thing. You have to spend on mining metals. So I think, and let's say another big area was cement, for example. But there, what's happening is that all your strong companies are doing acquisitions.
Yes.
So instead of building new capacity, they may be building some capacity.
Yeah, but it's largely acquisitive.
But it's largely acquisitions, right? So it's more consolidation that is happening in the sector than anything else. So I think in this round, it's largely being driven by the government on railways, on you know, on thermal power, you know, all the areas which require
PLIs,
heavy
yeah.
capex is being done.
Got it.
And then the government has rolled out PLIs. So I don't see any pharma company who has business not doing capex. I don't see any chemical company who has business not doing capex.
Sure.
I don't know of any auto company who doesn't want to set up electric vehicle capacity or increase capacity not doing capex. So I think, yes, I mean, I think what has happened is that the amount of cash flows that the corporate sector has generated over the last post-COVID is significantly higher compared to the amount of capex in aggregate that we are spending, right? And that's why I still believe that government capex is still the big driver of capex, because they've taken on the baton of doing, nobody wants to own a BOT project or anything like that today, right?
Got it. Okay. Okay. So then, therefore, explain to us, how are you thinking of investing in this new Samvat, not necessarily for 12 months, because your horizons are longer.
Sure.
Gains may come ahead and you may book, that's separate.
Yeah.
But you invest with a longer horizon.
Yeah.
Where is it that fresh money that is coming in from investors, where is it that, where within the landscape do the opportunities lie?
So again, as we've been talking, you know, Niraj, for many years, that I still believe that the sectors which are leading post-COVID, which is your manufacturing, capital goods, real estate, you know, B2B lenders, as opposed to B2C lenders, capital market plays, right? Selectively in pharma, selectively in tech. These are all areas where we are seeing opportunity, right? Or let me put it the other way, the areas where we are not very excited about is the large private banks or lenders.
You've told this to me before, yes.
We're not excited about large cap tech, and we are certainly not excited about large cap FMCG or consumer names, right? On the consumption side, we continue to play everything that is premiumizing, right? So we believe that India has now reached that per capita, and especially the top 10% of the population is rich enough to spend like a developed country, right? We're very bullish on real estate. We think that this new real estate cycle that we are seeing has much longer legs. You know, A, the industry is consolidated. B, the players are much more cash flow focused. They're completely deleveraged. And C, I think the amount of wealth that has been created, the amount of market cap that has been created in the last 4 or 5 years, every promoter is richer by 4x or 5x of what he was, right? Every PE guy is getting an exit, right? So let's assume, you know, while the top 10% of the promoters in India might be buying real estate in London or Dubai, but the next 90% who's become wealthy
Have to buy it in India.
will buy it in India.
Yeah,
And
yeah.
that's the largest consumer discretionary item that you spend when anybody becomes rich.
That's true.
Right? You upgrade your house, you buy a bigger house, you buy a mansion, I don't know, whatever. Right? You buy a 100 crore flat, you buy 50 crore flats.
You become richer. What are you buying? A mansion? A house in Dubai?
Nothing, just plowing it back in equities.
No. So you are playing the real estate cycle via real estate players and not necessarily the ancillaries, because a lot of people say we don't want to buy real estate companies, we'll buy the, you know, the pick and shovel. You're not doing that.
Yeah, but I mean, that was great until the, you know, until the industry dynamics were very bad, right? So people said,
Yeah.
you know, I don't want to buy the real estate company, so let me buy the tile guy
Exactly.
or the faucet guy or the paint guy.
You're not doing that now.
Right? I mean, those are, I mean, you've driven their valuations to like 50, 60, 70 times earnings like a consumer brand business, but you don't want to buy the actual real estate guy who's making cash flows today, right?
Okay.
And I find it very interesting that, you know, in the peak of the 2007-8 cycle, real estate was 7% of total market cap.
Exactly.
Today it's sub 2%. Not a single real estate
On the
company
Nifty or the Sensex.
is part of the Nifty, right? How can that happen? And every developed or developing economy which has grown, finally their growth cycle has ended with a bust in the real estate cycle. We are far from that,
Far from that.
right? So consumption, I think real estate is one, you know, premium consumption is where we think incremental money is going to be made. And instead of, where it comes to small ticket consumption or staples and, you know, the traditional FMCG, I think that industry is ripe for disruption, in my view. You know, the top 10 FMCG companies have a market cap of 25 lakh crores, right? They're growing at like single digits. And their valuations are very high. And I think quick commerce will come and disrupt them, right? So there is going to be a market cap value transfer from FMCG to the quick commerce guys, right? So today you have one, Zepto will also come in some point in time, Swiggy is getting listed. So my view is that we are, you know, we are at the dawn of creating a few digital giants in India, right? Again, we did a study that if you look at the Chinese market, in China, you know, 20 years ago, the total market cap of all internet companies was like in the year 2000, you know, early 2000s was like 1 or 2%. It peaked at 30%. And then after the crackdown on you know, the internet entrepreneurs in China, it's still at 20%, right? We're still at 1.5%, 2%, right? So I think we have a long way to go. Obviously, there'll be a lot of new listings which will add to that. But I think that I still believe, for example, instead of buying individual insurance companies, I would buy, for example, a PB Fintech, right? Instead of buying a Lever or an ITC or a Marico or whatever, I'm happy buying a Zomato, right? So I think that there is going to be the whole internet digital revolution that we have created, because we created this infrastructure, means that structurally these guys can take away market share and they are far more cost efficient, right? Because pehle kya hota tha, Lever would spend money on creating a brand, marketing, then its own distribution. Nestle did the same thing, Marico did the same thing. Every guy had to replicate its own infrastructure. Now today, you have a platform which has common logistics, right? You have specialized logistics company that can deliver to any pin code in India that you require. And I think they're disrupting the market. So my sense is that the time for the platforms have come. And, you know, I still believe that while some banks are extremely well run, and I must say that ICICI stands out, absolutely. If there's one private sector lender that I would buy, it would be ICICI, but we don't own any. But I think that as the depositor has moved from depositing money to investing in mutual funds, I think you're better off buying an asset manager or a wealth manager. Just follow the money, right? It's so difficult to raise deposits today. Maybe that will change once liquidity improves at the margin. But my point is that by buying a big bank, you are essentially buying 15, 16, 17% earnings compounding. वो तो आपको asset management या wealth management में भी मिल जाएगा with no balance sheet issues, no leverage, no deposit झंझट, no RBI putting a brake on unsecured lending. There are just too many headwinds, I believe.
Got it. Okay. Well, we do have 2 minutes. I'm tempted to ask you this one final question. I could have done multiple things. Maybe a health. So, okay, 1 minute each. I'm going to split it up. 1 minute each. 1 minute on alcohol consumption, because the con calls of all companies point to a very strong second half and times ahead. You've spoken about premiumization. 40 seconds. Are you constructive on liquor in business in India?
I am, Niraj. In fact, one of my top 5 positions is the largest spirits company. But we've also invested in other homegrown spirits companies, because I think what's happening now is that the Indian consumer and even the global consumer is accepting Indian brands extremely well.
Most certainly.
Indri, Rampur, right? I mean, you look at it, and I think in the world of spirits, every 5-10 years there is a trend. You know, there was a trend for Japanese whiskies where everybody just went completely crazy after Japanese whiskies. I think the trend for Indian whiskies is coming now.
Brilliant. Okay. Last thing, a health tip, something that you handle, because I know you are a health freak. One health tip, this Samvat for the next 12 months.
You know, I just feel, Niraj, that it's very interesting, because even during lunch on our table, there is constantly chatter about what to eat, what not to eat, what to do. Somebody will say, I exercise, somebody will say, I walk. I think the most important thing is whatever you do it consistently. Have the discipline that at least out of 365 days, you follow that thing for 300 days, right? You may have 50, 60 days which you kind of have fun. I think the key is everybody starts with the big gusto. No, after Diwali, I'm going to do this. Or after, you know, suddenly 1st January, I'm going to be in the gym and work out for 2 hours. It's not that. How consistent are you is going to give you results. So I think just be consistent, whether it's with your diet habits or with your exercise habits.
Or with investing, maybe, that also.
Exactly.
But Hiren Ved, so special talking to you today. Thanks for taking the time out and being with us and giving us your insights. To you and yours, once again, a fabulous Diwali.
Thanks, Niraj. Thanks for having me.
And viewers, thanks for tuning into this very special edition of The Talking Point.